Hello, John McConnin here with favoriterealestate.net, and I have other websites. I was reading, let me see, the 25th. Today is the 25th, and we've seen these balloons floated before about what is the Fed going to do about interest rates, but I'm just getting the sense of reading the financial papers and having investments like other people. I'm capable of trading 30-year bonds at times, although I have not lately. I have friends who used to work on the floor in the pit in Chicago, and I was talking to them. By the way, some of those guys who made millions in the pit got themselves not wiped out, but lost millions trying to predict what the Fed was going on. So in no way am I claiming to be an expert or anywhere else. But I saw in the Financial Times that the Fed is weighing its options on how to raise interest rates. The Financial Times is one of the places to get your good information on the markets. It's one of the best. Um, when I used to do a lot of trading, I like to read the Financial Times for sort of the establishment view, and um, Investors Business Daily for finding stocks that could double or triple in value because their earnings were growing so quickly. Um, so if we're reading this in the Financial Times, the Fed is seriously considering raising the rates or wanting people to think that to see if maybe that calms down something. Remember, Bernanke had to walk back. He said something felt like a year ago and had to quickly walk it back after the market collapsed. So this might be a trial balloon to test the market, but they do. I mean, the article's pretty interesting. I'll leave a link to it under the video, talking about that the Fed can set um, interest on reserves for the banks. And if they move it up to 50 basis points, no bank's going to loan for less than that. And that would affect things going up. However, the Fed also has to target Fed funds. And, they're going to have to find ways to control it but there's still a problem because not every market player can deal with the Fed. That means market interest rates such as Fed funds will not necessarily track the IOER rate. For example, the current Fed funds rate is 0.09%, and it has fluctuated between 0.07 and 0.20 for the past few years. Given the Fed expresses its policy as a target for the Fed funds rate, it is extremely uncomfortable for the central bank to have it out of its direct control. Um, so what does this mean for sellers? Well, first of all, we did a market update on Poway, but if you look around, the market has been a lot of people are making moves. Houses were put back on the market, and buyers were buying the ones that were well priced very quickly. If you look at the new ones coming on the market lately, last week, I get a sense people are really sort of extending up, trying to get higher prices. What does that mean? If you're a seller and you're willing to go up a little bit from where the market is, you'll probably get some interest right away if your house shows well. If you were a buyer, it's a little more difficult because, I mean, if you think about how much right now with interest rates the way they are, then you can control $1 million. You can get $1 million for $7,000 a month. Um, that buys a lot of house. Now, if interest rates go up a bit, the market might be able to absorb that, and prices might continue to rise. If interest rates went up a lot, you would expect some pullback in the price of housing. However, you would also your cost to buy that housing would go up. So, it's hard for me to tell a buyer anything other than if you see a house you like that you could afford now in San Diego, I think you have to seriously consider buying it rather than trying to time the market because there are not great selections of great properties available. It's it Those turn over very, very fast here. And you just have to follow that market to understand that. So, yeah, the price could go down a little bit if interest rates went up a lot, but you might still be at a rate you can afford. And, if you're a strong player, if you've got a good income, um, we've seen what's the most recent example? Prices went down, prices rocketed back. So if you're in there for the long term, we know until I don't know if anyone expects inflation to ever go down. Right now, they're hiding inflation. I mean, food prices are skyrocketing, housing prices have gone up. In an inflationary environment, you would expect one of the good places to have your assets in most inflationary environments is housing. So I think my conclusion on this bubble from the Fed about them raising rates, I wouldn't expect them to raise them a lot. If I was a seller, I'd put my house on the market now if I was considering it. If I were a buyer, um, and I saw a house I like, I would still buy it. I mean, I recently bought a house in January. I'm happy, even if the price went down a little bit. Now I think I even got a little cushion. Price went a little bit lower, so what? I can afford my house. I like the monthly payments. I like the schools. I like the location. I'm happy in my house. So if you're happy in your house, if you think you'd be happy in the house you're looking at, I think you ought to buy it. But that's not a financial prediction. John McConnin, favoriterealestate.net.